Alright everyone, it is Friday, May 25th, and time for another weekly wrap. It's been a pretty good week for trading. My members have enjoyed several different profitable trades this month, especially based on some of the projections from last week. So let's go ahead and dive right in and take a look at some very important areas. I've switched to a monthly chart here for the British pound. And the reason why I've done this is I want to highlight an area on the chart that I think is going to be important in upcoming days. You can see here that based on the move down, this was from the high here in 2004 down to the low here even into 2006, that the market has a projection up to about 2.0231. So this 2231 level, I think, is going to be at the very least some strong resistance for the market. It represents the 1.272 extension, which is typically a sign of resistance. The reason why I like this area as well is the market has gotten up here relatively quickly. If you notice, it's taken basically a year for the market to get here, when it took it well over 18 months or so to actually complete this entire move. This move started actually in late 2004. Remember, this is a monthly bar, and it actually didn't start moving up until here, the very first part of 2006. So we've got about an 18-month cycle down and a little less than 12 months up. So because of the speed of this is falling right into what I call the sneak attack, where the marketplace will penetrate through a high very, very quickly, push up to the 1.272 level, and then start coming down. So we're going to have to keep this 2.0231 level in mind, especially coming up in the next few weeks to months. Now you can see here from the monthly that this 95.50 level posed for a good source of resistance for the market. And I say that because you can see that the market had several tries, both on the upside and on the downside, to move past this area. But there was a lot of disagreement. Okay, so when you're looking at an area of the market like this and you see that the market generally is just moving sideways, this represents very strong opposing forces. What that means is you have traders that are trying to push the market higher. You can see those two spikes up here, and traders which are trying to push the market lower. Now, this isn't an extremely scientific method for determining which direction the market might go, but I will say this. If we take a common sense approach to the way the market looks, and if you've been listening to these weekly wraps for any length of time, you know that above all, I appreciate looking at the market in a common sense way more than anything else. All the squiggly lines and indicators and things that we can put on our chart don't do half as much for us as traders as just simply looking at the market and seeing what happened. So you can see that the market, when it started pushing up here, this 85.94 level, it started pushing up, and you can see 2 months in a row that the market went from the low up to a high and closed right on the high, 2 months in a row. Now that's very, very bullish. But then we can see that immediately the market slows down and we get this spinning top formation. We get another spinning top formation. Finally, we start getting hanging men. These two these two bars here are doji or hanging men type of formations. At any rate, all of these candlesticks are representing a battle, and the battle is between the sellers and the buyers. And it should be obvious, but again, I won't assume anything. The buyers, if you will remember, are thinking that the market is going to go much higher. The sellers, on the other hand, are thinking that the market should be much lower. So we have the conflict. Now, when you're looking at the sellers, though, the selling activity is either going to be represented by this, a down bar, or the selling is going to look like this. You see this little spike here at the bottom of the candle? This little spike here, this spike here, this all represents selling. Now, the reason why candlesticks are so effective is because it makes these little wicks here, these little spikes down, and even the spikes up over here and over here, very obvious. Okay, that's really the main purpose behind me using candlesticks, because they're obvious spikes on the chart. And bar charts, you really just don't get the same effect. I'll go ahead and switch to one. And they just look like they're all the same. I really have to focus and try and concentrate and see. There's a little tick right here where the close is, a little tick over here with the open.